Hi everybody, you can see the beautiful sunset over there. The sun has just set and it is really nice and red, but I think I got it too zoomed in. You know, it's kind of hard to control it like that, but look at this beautiful beautiful situation here. So I'm out here, look at the beautiful sky, and I'm going to get myself in this photo, but you can definitely see what a beautiful evening we have. So I'm here to talk about a few things and get myself in this sunset scene, but you can just see it's just totally wonderful. Anyway, so I'm going to start my video now. I want to talk about how to get wealthy or how to get rich. And one thing you should do if you want to get wealthy is to start early. So you should do this as young as possible. The next thing is, about 6 years ago, I was doing some research in some local public libraries, you know, just checking out books on the subject. So how do you get wealthy? And there are a few things that these books all had in common. And three of them that I can say applied to me that are pretty easy for just about anybody to do are three that I'll mention right now, okay? So one of them is start saving money, okay? So you can do this by the week or by the month, and you should probably have like big goals and small goals. So a big goal would be, let's say, try to save a certain amount, a particular amount per year. And then a smaller goal would be also that in order to meet this bigger goal, you try to do it by like the month, like divide this big goal by 12 and say this is how much I have to save on average per month, and try to save at least that much every month. And then you can break it down further, like into weeks or paychecks or however you want to do it. We got these gnats flying around here. So anyway, so the first thing you need to do is start early and save money. Then the second thing is work, okay? Because if you got a job, then it's easier to save money. But you can, even if you don't have a job, if you have a regular source of money like that you use for your food or something, and there are not restrictions on, you know, how you can do it, you can probably save a little bit. And you know, even if there are, I mean, I don't really know what kind of restrictions you might be you know, subject to, but if it's something that you can save a lot for your food, you can just call it food money for later, okay? So anyway, the next thing you should do is not only just save your money and work, because if you work you've got income, but try to have a source of money, like if it's not work, something that gets you paid or gets you some kind of income or money, you know, regularly. So that's the second thing. I mentioned start young. The third thing, though, is you might want to try to invest. And if you're going to invest, one thing you can do is start out with like a mutual fund, okay? So mutual fund would be something like, you know, you can just check these out, but you can get them through like well, I get mine, I got started through Edward Jones. So what they call is like an investment firm, you know, like a company that does this sort of thing. So Edward Jones, go in there and talk to somebody. Say you want to start investing in a mutual fund. Because if you start with something that's not going to mess you up like stocks can, if you start with something, you know, less risky, then, you know, you can learn more as you go along. So you need to start educating yourself about investing. Just find out all you can, like go on the internet and look up stuff, you know. But don't believe everything you read, because there are stocks recommended that do terribly. And if you just do your own thing and don't take advice, you can really goof up. Like, let's say you think, oh, this stock's doing really well and you want to invest in it, and then the next thing you know it crashes, or sometimes they drop completely out of the market and you'll never get your money back, or there's like a settlement and you get very little at all, next to nothing compared to what you invested. So be careful with stocks, but with mutual funds, they're managed by managers. So these managers buy and sell these stocks. For example, they give you like a monthly or 30-day period to tell you what stocks they held and what percentage of the fund was held by what stocks. So it's always changing. So you're not going to be responsible for the loss of this. I mean, just the fund can lose too. Like if the market crashes, your fund can really go down in value, but then that's a great time to invest. Like if you're making regular additions, that is, you put in like the same amount every month into this mutual fund, when over the long term, like over the decades, the crashes are actually going to benefit you a lot, because when it crashes, you just keep putting money in, and when that market crashes, your money goes in at a lower rate, which means that when the market rebounds later, you are going to be making a lot off of that. So actually, some people wait for a crash, or that's what I would say. You know, it's when the markets are doing well and they've been flying high for a long time, that's not necessarily the best time to invest, because sometimes when they're really high, then they can crash, and you can lose a lot. But if you do regular inputs, they call regular additions, that's one way to like ensure, because there's going to be irregularity in the markets, and then those affect the mutual funds. So if you actually use regular additions, or even wait till the markets are low and then put it in, if you got the patience, like I said, start young, wait, and make it a regular thing. Save money regularly, invest regularly. You are going to come out like 20 years later, 30 years later, 10 years later even, you could come out with a substantial little bit of a, you know, like a little mini fortune there. You could have $1 million in a mutual fund or in mutual funds before too long. And then, like I said, educate yourself, like make it a passion to learn about money, and learn all you can about investing and all this sort of thing, and really try to find out, and be careful, like ask your investment representative for advice. Like if you go to Edward Jones or some other one, Edward Jones is a big popular one, but talk to the individual there and find out all you can. Ask questions. Don't take their advice lightly, because if you don't follow their advice and they say don't do this, and you do it anyway thinking, oh, you know, you're going to make it rich, but sometimes just the opposite happens, and these guys are a lot more careful about what they say. And so when they advise you, you know, you can have a better chance of not losing everything if you heed their advice, because you know, I've made the mistake of just as a beginner going out on my own and thinking, well, you know, the markets are flying high, and I'm not really going to have to listen to this advice. I just want to put in some of these high-flying stocks, and they were just totally crashed out to nothing after that, because there was a big crash. It was the tech bubble. It started in around March of 2000. You can look it up on the NASDAQ. Do this search. Key in NASDAQ Composite Index or something like that, and get yourself a lifetime view of the NASDAQ, like the chart, and look right around the year 2000. There was this big buildup for about a year, 2 years, and then there was this terrible crash. The NASDAQ index was like at about 5,000, and it eventually, within the next year or two, got as low as 1,200. And it took a long time to rebound, but you know, you could have been taking advantage of that crash if you know what to do. Just make a lot of additions with your money when it's low, and then over time, now there's this huge, it's almost like another bubble, this huge bubble, because you know, we could be due for a crash, we might not. And when I'm making this, today is the 14th of September 2018. Another thing is, you never have it in the clear until you sell what you have, because okay, there are fees. Every time you buy or sell something, you incur a fee, or it's a loss. Even if it's a mutual fund, there's like a load on it. Okay, you can figure that out. But what I'm saying though is, you might have like this big gain over a long time, but you're never in the clear unless you can sell that, because it could crash. So that's just something to keep in mind. You shouldn't sell your stuff needlessly, because you know, it might go up more, and then it costs money to sell it, and it costs money to buy in again. But on the other hand, I just want to warn you that, you know, you think you might have this fortune made, but if you don't actually cash out, you could lose it all if there's a big crash. And sometimes these crashes change a lot more suddenly than the buildup. So you could have a buildup that takes a year or 2 years or something, but then the crash is just really quick. Like if you look at the graph, it's a more gradual slope up to the going upwards. But then when it's the crash, when it goes down, it's a real sudden, sharp crash. So if there's going to be a crash, you've got to act quickly. So that's just something to keep in mind, is you never really have your fortune until you can sell it off. I mean, you might have it, you might not, because you know, the markets might hold stable or they might increase, but there might be a crash. So anyway, I'm going to cut out because this has been getting a bit long, but I hope you enjoy what I said.